All right, Dinshaw Irani joins us, and let's say hello and good morning to him.
Good morning, and a very good morning to your team and the viewers as well.
All right, Dinshaw, there's reason to smile this year, whether it's gold, whether it's Bitcoin, whether it is mutual funds, whether it is bond market. The smiles which I hear in the month of December 2024, do you think they will stay for next year as well?
So, Nikunj, actually, I'm smiling on the statement which Aman made that flat as a pie. So that's what I liked, and that's why I was smiling. But anyway, I think going into the next year, that is what your trend is gonna be. I don't think the basically if you look at the NSE 500, it's given a return of almost 20%, 19.5% year to date, I believe, right? Going into next year, I don't think that kind of returns can ever repeat. I mean, in at least in FY25, a lot of uncertainties out there. One obvious one is the rapid decline in demand, domestic demand per se. I mean, you've seen that Godrej consumer had to come way early and warn about how he's seen his demand going into this quarter as such. In fact, it's deteriorated from the September quarter. And looking at things, I mean, the fact that the government started spending only in October, you're hoping that the private sector capex will kick in, didn't kick in. I think that trickle down effect will take at least a couple of quarters before it goes down to the consumer level as such. So that is one major uncertainty. December quarter is going to be doesn't look like a very exciting quarter. The numbers I'm talking about, again, if Fed rate cuts come in, there'll be some uptick, but beyond that, again, on the demand front, don't see much of a upside there. And obviously, the biggest uncertainty is with the new president coming into the US and what kind of views he's going to take on his economy. He's going to have a trade war going, I think, starting off itself, not healthy for the world itself. So maybe there are things which are fairly uncertain, and that's why we'd be rather cautious. I think if one sees a high single digit kind of growth in the markets next year, that should be enough for you to smile, I suppose.
You've been bullish on banks. You launched a sectoral fund which is dedicated to banks. Banks are a function of demand, proxy to the economy. So, I mean, if economy is slowing down, which is logical and which is visible, then why should banks do well?
So, Nikunj, actually, if you see it's not a banking fund, it's called a financial services fund. But if you see that fund, it's mainly the weight is towards financial services. Obviously, banks are a big weight there, but it's financial services. And mostly the financial services are more leaning towards the plays which are related to the stock markets, right? I mean, if anything, India is in a phase where you can only see more participation in terms of the wealth creation that is happening in our country. I mean, you'll see only more participation happening. And that's why all these services parts, be it, say, diversified brokers or the depositories or even RTAs, exchanges, these are the ones which will benefit a lot. And frankly, I mean, as I said, that more or less it looks like RBI will be forced to do a rate cut in Feb, given the way the demand has been collapsing. If that happens, that's a very big positive, even for the NBFC part of that business, right? And looking at the infusion of liquidity in the system, obviously that makes life more simpler for the banks to raise deposits. So the lenders are also now getting benefited with the liquidity infusion. Obviously, when the rate cuts happen, you'll see some kind of uptick happening there. So I think we're in a good space in the financial services part. Whatever happens, this is the place where we believe that the growth will be given. In fact, what we always say is what we learn from history is we never learn from history, but history repeats. And if you see all economies where growth has kicked in, this financials and services part has done phenomenally well. And that's why we stick to that. And I think that's one area which will do very well. In fact, not only my financial services, but if you look at my other funds also, a major chunk of our weight is in banks and financial services.
Okay, what apart from financial services, Dinshaw is looking better? Where would you incrementally put money to work?
So what our belief is, in fact, we went in quite heavy on IT way back in July itself because we saw the June quarter numbers and we were quite kicked about it. I know Nikunj has his concerns that even the mid-single digit kind of growth, how much can that support the the valuations per se. But the fact is that the commentary from June onwards has only been getting better. Once on the September quarter, again, the commentary was much more bullish, not bullish, rather much more uptick was happening in that commentary. And I'm sure December will be no different. If anything, you'll see that there'll be narrowing down of the growth estimates. And obviously, there may be some uptick in the higher end of the growth estimates going forward. And our, again, belief comes from the fact that since the major market is the US, for most of the IT plays, US has done fairly well. And looking at the policies of Trump, which are more of inflationary, it looks like the new president, that is, it looks as if that economy will continue to do well as such. So we don't see a problem in our positioning on the IT space. I think that's one area that we're very comfortable with and very bullish on, even given the valuations the way they are today. Because our belief is that going forward, it will only go up, the growth rates will go up. And one more area that we've been fairly bullish on are the platform companies. They're spread across various categories. Some are in finance, some are in consumption, and in fact, a couple of them are in autos and pharma and stuff like that. So we are very bullish on the platform companies. I think this is the new age technology which India has really caught on to. And we don't see a problem there also. So if you see my portfolio, all these three put together would be around 65% of my portfolio. And that's why we're comfortable.
Okay, interesting. So you're pretty upbeat on those platform companies. You know, it's a very divided view coming in on whether or not to look at that space as a whole. What's the sense that you're getting when it comes to financials, and how is it that you would like to play that sector? Would you continue to remain cautious there as well, or are you looking at just quality names?
So Aman, actually, the fact about finance is that it should do well if the economy is growing, and I don't see India not growing. Right, that economy, our economy has to grow. Secondly, you have to be very selective in that space, and I think that's what has helped us in being selective, in the sense that we've been only concentrating on quality of assets when it comes to the lenders part, right? So that's why if you see my portfolio, very selective even in the banking space. We don't have the banks which had exposure to microfinance sector. And I remember September quarter numbers, one of the banks which is heavily into microfinance releases numbers and was around some 20% odd. And that's a large cap we're talking about, index representative and Nifty 50 representative. So it's obvious that these kind of banks you need to be away from. So you've got to be very selective in that space. Even the services space, we are not, or rather in the NBFC space, we are not doing any carpet bombing here, because we know that with the fight going on deposits per se, their cost of borrowing will move up substantially. That's why we've been very selective in that space. We've got only a couple of NBFCs in our portfolio. Services, we continue to be bullish, and as I already said, that it's more related to the gatekeepers of wealth, if you will, which the ones which are into that is what we are more focused on. So we are very careful in our selection, and I think we're very prudent in the way we've gone about building that part of the portfolio.
So Dinshaw, what is the template which markets are working with for 2025 in terms of earnings? Do you think it will be a slow grind? Could the earnings come back, or will they disappoint? Will they continue to disappoint the way they've disappointed in the last 2 quarters?
So, Nikhil, actually, if you see the earnings started tanking from June onwards. I mean, March was still a fairly reasonable quarter. I'm talking about March 24. I'm talking about the March 24 quarter was a fairly reasonable. December was fairly strong. March 24 was when you first saw some amount of cuts happening on the estimates, forward estimates. But from June onwards, it's really deteriorated. And obviously, September was the worst. And actually, we thought that probably September will be the worst quarter. Going to December, we'll see a trough happening. Doesn't look like it. I think December also looks fairly bad as compared to what one saw in the YY numbers as such in December. So maybe you'll see some kind of semblance coming back in fundamentals going to the June quarter. So basically the call out that we're saying, even if it's a flattish, I mean, rather a single digit kind of growth market that we're talking about, I think the bulk of the run will happen only in the second half of the year, calendar year, that is. And that's when you'll see some kind of semblance coming through as such. So that's what our call is, and that's why I think we're fairly cautious for the next couple of quarters. I think we'll be more in defenses than in aggressive sectors. It's going to be a stock pickers market, no doubt. There'll be pockets which will do well, and there'll be pockets which will really fall off the cliff.
Where do you think the consumer tech and fintech space is headed? I mean, we had a challenging 2022 and 23, but a great comeback in 24. Will this party continue in 25 as well for consumer tech and fintech?
I think so, Nikhil, because actually, if you see, if demand is going to be a constraint, these are the tech companies. I mean, the consumer tech companies or the fintech companies are the ones where everybody's going to run for. I mean, my belief is that the compression in margins for most of these established brick and mortar players in the consumer space has been because of the consumer tech companies as such. Quick commerce, food delivery, all these spaces are going to look very exciting. In fact, quick commerce is something which is really homegrown. I mean, it's globally there's not many proponents of this kind of a business. So it's done phenomenally well in India, and that's one of the homegrown strategies which has worked out. And I don't see that backing off, given the fact that people are always looking out for deals. And quick commerce was earlier not supposed to give out deals, but now they are giving out deals, and they're competing with e-com players also. So that's why our belief is that this segment should continue to do well. There's enough potential. There are 3 established players in the segment right now, obviously, but there's enough potential for more players to come in, even if they do. Quite a few established players have tried their hand in this, but they have not done that well. I think it's not only about the platform which matters, it's how you bring about the strategies, how you place your stores and stuff like that, the dark stores rather. I think that matters a lot, how you get that going. I think that model matters also. So the established guys will continue to do well. Maybe there'll be a few more new players coming in. We don't have a problem with this. I don't see that happening as a problem. Even in the fintech space, the largest guy is obviously what we own. And I don't see a problem there also, given the fact that he already had a regulatory issue. He came out of it pretty unscathed. Back to the prices that it was earlier at, and I think enough growth potential there. In fact, once one really saw the kind of franchise that he's built, in the sense the moving parts that he had. Every time he just has to sell one portion and he raises like 2,500 odd crores, 2,000 odd crores and stuff like that. So I don't see a problem there also. 12,000 crores of cash lying in the books doesn't look like a problem going forward.
All right. Really appreciate your time, Dinshaw, and certainly hope to see more of you going forward.
If you like this video, then like, share and subscribe to ET Now.